Hello and welcome to another session of Writings on the Wall, presented by HighView Financial Group, Canada's outsourced Chief Investment Officer. We take great pride in facilitating dialogue in the management of wealth. As HighView believes in education and transparency, we feel it is important that investors understand how they are invested. And in this video, we wish for investors to gain a better understanding of pool funds. So let's review. What are pool funds and how do they differ from mutual funds? Pool funds, like mutual funds, commingle investor savings for the purposes of investing. Investors hold units in the pool fund, and ideally the unit holder, also known as the investor, achieves lower costs for portfolio diversification and benefits from the efficiencies of scale. Unit values are calculated by taking all the underlying investments in the pool fund at a specific date and dividing by the number of units issued and outstanding. Unit values fluctuate based on the value of the underlying investments. All of this sounds familiar to a mutual fund. However, pool funds differ from mutual funds as they do not require a prospectus. They are generally not advertised, they typically have lower fees, and they are not available to the public at large. Pool funds may have daily or monthly liquidity. Pool funds usually issued in Series A, F, or O. Each of these series will be explained further on. Now, there are concerns to be aware of when investing in pool funds. Pool funds must distribute annually all interest income, dividends, and net capital gains. Any capital losses are not distributable but used to net against capital gains. Also note that your annual distribution is unrelated to your unit value. This can be confusing at times because there can be years when capital gain distributions are made to you as the investor due to the manager selling investments within the pool, all the while your unit value or your investment may have experienced a decline. Regardless of when you buy units of a pool, annual distributions are completed pro rata. In English, an investor who purchased units in November will receive the same year-end distribution as an investor that purchased in January. For this reason, you want to understand what the estimated distribution for year-end will be should you choose to buy units in the last quarter of the year. You certainly do not want to be hit with a surprisingly large distribution when you were not invested for very long. Transparency of fees. As mentioned earlier, pool funds are typically available in Series A, F, or O. Each series is designed for a different management fee structure. Series A includes a management and advice fee bundled together, totaling, let's say, 1.87%. Brokers may use A series in their client accounts to receive the trailer fee from the pool fund manager, typically 1%. You want to be careful that you are not paying a Series A fee and also paying a fee for service, the infamous double dip. Series F separates the management fee and the advice fee, also known as the fee for service. For example, 0.87% for management fee, and the broker charges an advice fee separately for 1%. The F series is becoming more common as brokers move to fee for service models. Please be aware that CRM2, the new regulation forcing more transparency and disclosure, only requires that the fee for service or advice fee be disclosed, not the management fee, or the 0.87% in this example. This can be found in fact sheets or by asking the question directly. Series O is typically reserved for institutional or very large accounts. Fees are negotiated separately and charged outside the pool. For Series A and F, many investment managers charge their investment fees inside the pool. This does not provide complete transparency of fees, and we ask that you use caution. Some investment managers also charge performance fees in addition to management fees, and it is important to understand how the performance fee is calculated, and if there is a high watermark. In English, the high watermark is the level of performance that needs to be achieved to then trigger additional performance fees that is rewarded to the manager. It is important to note that typically when switching from one pool to another, it will not roll over performance history. Each pool stands on its own for performance metrics. This may mean you lost money in one pool, and then when switched to another, the high watermark starts fresh and does not carry over. So, you could effectively pay a performance fee even though your total portfolio value declined in the year. HighView believes that all management and advice fees should be completely transparent in dollar value, and fees should be available for tax deduction purposes. For this to be done, management and advice fees should be charged outside of the pool. Aside from management and advice fees, there are operating costs such as audit and legal, as well as trading costs. It is important to understand this because at HighView, we often say that the fee is not always the fee. Understanding the financials. The best way to understand how a pool has made its return and what the associated costs and various metrics were throughout a year is to review the audited annual financial statements. Unfortunately, most investors waive the option of receiving these financials as it's hardly something to do with your free time. However, there is very useful information found in the details. In this regard, we wish to point out specific areas found within the financial statements which might be of interest. Statement of financial position. Review current assets to gain an understanding if the pool has experienced growth or redemptions. A significant decrease in assets should be a red flag. Statement of comprehensive income. Review the income and expenses to understand how the pool made its return and what the expenses were. Any extraordinary expenses should be a red flag. Statement of cash flows. Review the proceeds from the sale of investments and purchase of investments to understand portfolio turnover characteristics. Large figures for buying and selling is an indication of high turnover and should be a red flag. If you do not receive the financials, we recommend you request them from your investment manager. Understanding distributions. Distributions are not to be confused with dividends. A distribution can be made up of interest, dividends, foreign dividends, capital gains, and return of capital. Return of capital, or ROC, is often associated with pools that pay out a monthly distribution or higher overall distributions to their investors. Since ROC is simply the return of the money invested in the pool, it will lower your adjusted cost base, or in general terms, your initial investment or book value. For taxable accounts, this can result in a cost base that decreases quickly, which will lead to a significant capital gain when you eventually sell. Also, if you step back and think that return of capital is the investment manager returning a portion of the monies he or she manages, what happens when the pool fund receives a lot of redemption requests, meaning investors want to pull their money away and sell? Well, obviously, there will be less capital available to return to the investors that have stayed invested for their distribution, and more often than not, this causes a cut in distribution and expected investment income. We have shared a lot of information regarding pool funds and their structure, and at HighView we recommend the following questions to ask when investing in them. Number 1, ask what is the purpose of the pool. Is it for income? Is it balanced? Or for capital gains and growth? Number 2, ask what are the historical performance and metrics of the pool. Number 3, what is the total fee? For Series A, remember the posted fee covers both management and advice. For Series F, ask what are the separate fees for management and advice. And for Series O, ask if this option is available to you as the investor. Number 4, can my fees be tax deductible? Meaning fees being charged outside the pool. Number 5, what is the historic makeup of the distribution? Meaning dividends, interest, or return of capital. And number 6, can we review the financial statements together? Here at HighView, we have an in-depth process for evaluating investment managers. We believe that advisors and investment managers should provide full transparency of all investment solutions recommended to clients. This transparency should include all aspects of the client portfolio with respect to fees and costs so investors can easily understand a total cost of ownership. Unfortunately, the Canadian investment industry packages their services and investment products without full, true, and plain disclosure, ultimately not satisfying the basic need of transparency. We appreciate you tuning in to another session of Writings on the Wall, presented by HighView Financial Group, Canada's outsourced Chief Investment Officer. If you have any questions or require additional information, please call our headquarters or email info@highviewfin.com. Thank you.